Welcome to XM.com for today's market comment by Ref Boyajian. I'm Cristina Marujos. After brushing aside a hotter than expected CPI report last week, investors betting on an imminent pivot by the Fed were emboldened on Friday from a very soft set of producer prices. The final demand producer price index edged up year on year in December, while the core PPI eased more than expected. It seems that the markets don't think that the CPI components, such as shelter costs that boosted prices in December, will keep headline inflation elevated for too long, with the PPI data reinforcing the view that underlying price pressures in the U.S. economy continue to ease. Year-end rate cut expectations soared to more than 165 basis points after the data, while the odds that the Fed would commence its rate-cutting cycle as early as March rose back above 80%. The biggest threat to upsetting these dovish expectations this week are Wednesday's retail sales, should December prove to have been a strong month for the U.S. consumer. Treasury yields came under renewed pressure as investors upped their predictions of how many times the Fed will slash rates this year. The U.S. dollar has been crawling higher for the past two sessions. One explanation why the greenback isn't tracking yields lower is the fact that other central banks are also expected to sharply lower their borrowing costs this year, so yield spreads haven't narrowed that significantly. But there could also be some caution at the start of the new trading week amid China reporting its fourth quarter GDP estimate on Wednesday and a number of countries publishing CPI data, including Canada, Japan, and the United Kingdom. China's central bank kept its medium-term lending rate unchanged on Monday, disappointing many investors who were anticipating a small cut. In equity markets, stocks in Asia and Europe were muted on Monday, following an underwhelming performance on Wall Street on Friday. The major U.S. banks kicked off the quarter four reporting season with a mixed bag of earnings, with some doubts creeping in about the prospects of some of the big tech names. This earnings season has gotten off to a shaky start. But perhaps the biggest danger is that when rate cuts are so heavily priced in, there's limited room for additional boosts from this compartment, so any disappointment in earnings could be quite damaging for Wall Street bulls. This was today's market comment at XM.com. Have a great week.